For the last decade, this was the boomer rock. If you bought this, it meant you were scared. It meant you didn't understand technology. It meant you were betting on the end of the world while everyone else was getting rich on Nvidia, Bitcoin, and SaaS multiples. While the S&P 500 was printing millionaires, gold just sat there. It did absolutely nothing. It was the definition of dead money. But then, 2025 happened. While most people were distracted by AI hype or election cycles, something in the global financial plumbing broke. Gold quietly went on one of the most violent runs in history, up nearly 65% last year alone. We are currently sitting at the doorstep of $5,000 an ounce. It's crushing the S&P 500. It's leaving Bitcoin in the dust, and it's doing it in silence. But here is the problem. I'm a fundamental analyst. I don't buy hype, and I don't buy lines on a chart. Before I invest a single dollar into a company, I run it through my Analyst Verification Test. I look for three things: revenue growth, cash flow, and capital efficiency. When I run gold, the single hottest asset on planet Earth right now, through this test, it doesn't just fail, it scores a 0. By every metric of corporate finance, gold is the worst business you could possibly own. So, why are the smartest money managers in the world, central banks, sovereign funds, and family offices panic buying it at all-time highs? Today, we need to talk about why my test fails on gold, why I'm buying it anyway, and whether it's too late for you to join the trade. First, you have to understand why I use this test. In 99% of investing, our goal is to find compounders. We want assets that produce new value. If you buy a share of Microsoft, you own a piece of a machine that hires engineers to build software that sells for profit, which is then reinvested to hire more engineers. It is a virtuous cycle. It is an engine. To find these engines, I use 3 pillars. Pillar 1 is revenue quality. Is the top line growing organically? Pillar 2 is cash flow reality. After paying the bills, is there cash left over to pay me, the shareholder? Pillar 3 is capital efficiency, ROIC. Is the management team good at turning $1 of investment into $1.20 of value? If an asset fails these 3, I usually throw it in the trash. So, let's grade gold. Let's look at Pillar 1, revenue quality. Does gold have customers? No. Does it have a sales team? No. Does it have a P&L statement? No. You might say, but wait, the price went from $2,000 to $5,000. That's growth. No, that is price appreciation, not revenue growth. Revenue comes from selling a product. Gold is the product. It generates 0 sales. Pillar 1, fail. Pillar 2, cash flow reality. This is where it gets ugly. High-quality companies print cash. Gold actually consumes cash. If you hold physical gold, you pay for a safe, you pay for insurance, you pay for security. If you hold an ETF, you pay an expense ratio. Gold doesn't pay you a dividend, it sends you a bill. In finance, we call this negative carry. Pillar 2, fail. Pillar 3, capital efficiency. ROIC measures how well an asset reinvests in itself. Gold is an inert chemical element, atomic number 79. If you put a bar of gold in a dark vault and come back in 100 years, you will not find a baby bar of gold next to it. It cannot reproduce. It cannot compound. It is statically dead. Pillar 3, fail. So if you look at gold through the lens of a business analyst, it is a disaster. It is a non-productive asset. So why is the price vertical? Where are we at $5,000? The answer is simple. We are judging a fish by its ability to climb a tree. My analyst test is designed to measure productivity, But gold isn't playing the productivity game. Gold is playing the scarcity game. You don't buy gold to get rich. You buy productive assets like stocks for that. You buy gold so you don't get poor. There are three massive engines driving this rally that have nothing to do with revenue or cash flow. 1. The trust deficit. First, geopolitics. For the last 50 years, global central banks held US dollars as their savings. But after the sanctions wars of the mid-2020s, countries like China, India, and the Global South realized that dollars can be frozen. Gold cannot be frozen. It has no counterparty risk. They are buying gold not to make a profit, but to declare independence from the dollar system. Number 2, the opportunity cost. Second, the Fed. In 2023 and 2024, you could get 5% risk-free in a savings account. Holding gold, which pays 0%, was painful. But now, in 2026, as rates are being cut to save the economy, that penalty is gone. When the bank pays you nothing, holding gold becomes free. The opportunity cost has vanished. And number 3, most importantly, the debasement. Look at the U.S. national debt. It's parabolic. The market has realized that the only way the government can pay this off is by printing more money. When they print money, the value of the dollar goes down. So gold isn't actually going up. The dollar is just going down relative to the rock. Gold is the hedge against the infinity printer. Now, I know what the comments section is going to say. Why not just buy Bitcoin? It's digital gold. It's faster. It's better. We have to look at the scoreboard for 2026. Why is gold at all-time highs while Bitcoin has been chopping sideways or lagging? Here is the hard truth. Bitcoin is still a risk asset. It correlates with the Nasdaq. It moves when people feel greedy and liquidity is high. Gold is a fear asset. It moves when people are terrified and trust is low. Right now, big institutional money, I'm talking sovereign wealth funds and pension funds, they are scared. They don't want digital energy and volatility. They want a 5,000-year track record of safety. Bitcoin is for growth. Gold is for protection. Right now, the world wants protection. Does this mean you should sell your house and buy gold bars at $5,000? Absolutely not. Nothing goes up in a straight line. There are two major risks you need to know before you buy. Risk 1, the blow-off top. When your Uber driver starts asking you about gold coins, the top is in. Sentiment is getting very frothy right now. We're due for a pullback, and buying a parabolic spike is the easiest way to lose money in the short term. Risk 2, the liquidity crisis. If the economy crashes too hard, a real depression, cash becomes king. In a panic, people sell everything, including gold, just to get dollars to pay debts. We saw this in 2008 and March 2020. Gold crashed before it rallied. So, how do we conclude this? I go back to my portfolio pie chart. I still keep 90% or more of my investment in productive assets, index funds, and companies that pass my Analyst Verification Test. I want to own the engines of the economy. I want to own human ingenuity. But I would like to start allocating some fresh money to hedge my portfolio. That is my gold. And personally, I would start with physical gold. I don't care that it fails the test. I don't care that it has no revenue. I own it because if the productive economy breaks or if the currency continues to crumble, gold is the only thing that stands tall in the ruins. It's not about getting rich. It's about not going to zero. If you want to see the specific stocks that actually pass my 3-pillar test, watch this video right here. Don't forget to subscribe. Thanks for watching.